Ever wondered how some traders seem to predict market movements with uncanny accuracy? Picture the stock market as a massive crowd of people, each making decisions based on their emotions. Technical analysis is like being able to read the collective psychology of this crowd through patterns in price charts. In today's video, we'll uncover how successful traders use this powerful tool to make informed decisions, and why understanding these patterns could be your key to better trading results. Ready to decode the language of charts? So let's start with what is technical analysis. Technical analysis is fundamentally about studying price movements and trading patterns to predict future market behavior. Unlike fundamental analysis, which looks at a company's financial health and business model, technical analysts believe that all necessary information is already reflected in the price charts. Think of it like weather forecasting. Meteorologists study cloud patterns, wind directions, and temperature changes to predict tomorrow's weather. Similarly, technical analysts study price patterns, trading volume, and market momentum to forecast future price movements. Okay, now let's study how exactly does technical analysis work. The core principle of technical analysis rests on three key beliefs. History tends to repeat itself. Prices move in trends. Market action discounts everything. When analyzing charts, traders look for specific patterns that have historically indicated particular outcomes. These patterns form the basis of technical indicators, which fall into several categories. Trend indicators. These help identify the overall direction of price movement. The most basic yet powerful tool is the moving average, which smooths out price data to show the general trend direction. Momentum indicators. These measure the speed of price changes. The Relative Strength Index, RSI, and MACD, Moving Average Convergence Divergence, are popular tools that help traders identify potential reversal points. Volume indicators. Volume confirms price movements. High volume typically validates a trend's strength, while low volume might suggest weakness. But how the practical application in trading could look like. Successful traders don't rely on single indicators but combine multiple tools to form a comprehensive strategy. Here's how they typically approach analysis. First, they identify the overall market trend using longer-term charts. Then they zoom in to find specific entry and exit points using shorter time frames. They look for pattern confirmations across different indicators before making trading decisions. For example, a trader might spot an upward trend using a 200-day moving average, confirm momentum using RSI, or wait for a specific candlestick pattern to enter the trade. With all these information, why technical analysis could work? The effectiveness of technical analysis comes from its self-fulfilling nature and its ability to capture market psychology. When many traders watch the same patterns and react similarly, these patterns become reliable predictors. However, success requires discipline to follow your strategy, risk management skills, understanding that no pattern is 100% reliable, and emotional control to stick to your plan. In conclusion, technical analysis isn't about finding a crystal ball that perfectly predicts market movements. Instead, it's about understanding probability, managing risk, and making informed decisions based on historical patterns. When used correctly, it becomes a powerful tool in your trading arsenal. Whether you're a day trader or long-term investor, understanding technical analysis can help you make more informed decisions about when to enter and exit trades. Start small, practice consistently, and always remember, the best traders are the ones who manage risk effectively. So, that's the end of this video. Now, if you have found the content helpful, don't forget to give a like and subscribe to our channel for more content like this.